Welcome back to MD Stock Analysis. In this video I want to take a look at a very interesting small cap company called ACM Research. They are based in Fremont, California, and they manufacture single wafer cleaning equipment for the chip industry. What I find very interesting about this company is that they are trading at a PE ratio of only 15, but all of their internal metrics are improving very rapidly, and they got around 50% year-over-year revenue growth over the last years. The market cap is at 1.3 billion right now. If we take a look at the stock price, we can see that it's very volatile because it's a small cap company. So the range is somewhere between $5 and $50 over the last 5 years. And right now it's trading at around $15. But in the future, I think if we take a look at all the internal metrics, that the stock price could go up 10 or 15 fold over the next 5 years for sure. In this chart, we can see the revenue of the company starting in 2017. As we can see, in 2017, they were doing 37 million in revenue, and in 2023, they did 558 million, and in 2024, they're expecting around 688 million in revenue, and their longer-term target is around 1 billion in revenue every year. If we take a look at the growth rate, the revenue is growing about 52% a year. But this is the entire revenue. If we look at revenue per share, it's actually closer to 47% revenue growth per share. If we take a look at the composition, the biggest part from that revenue is their cleaning equipment for the chip industry, followed by ECP, furnace and other, and advanced packing. But the start of the company was with cleaning equipment. That's why it's still the biggest part of the revenue of the company. Over here we can also see the change between 2023 and 2024 in the first quarter. And we can see that the revenue increased 105% year over year. And the biggest increase also was in their cleaning equipment, which has gone up 199%. Overall, if we take a look at the quarter, we can see that they did 152 million in revenue. Of that is 79 million in gross profit, which gives us a gross margin of 52%, which is very good because it leaves enough money for other operating expenses. They spend around 14 million on sales and marketing, around 24 million in research and development, which is very important for the future of the company and their products, and another 15 on general and administrative expenses. And in total, we come out to an income of 25 million. And after taxes, that's a net income of 17.4 million. In order to predict the future revenue growth of the company, it's also important to take a look at the serviceable available market for each of their products. As we can see, the cleaning equipment is the biggest market with 5.2 billion, and they started in 2009. Then in 2014, they also expanded advanced packing. In 2020, they expanded furnace, LPCVD, and other, which comes to a market of 2.2 billion. And then in 2022, they also added track and PECVD, which also had the possibility of growing their revenue in the future. Even though the company is based in Fremont, California, they have 3 manufacturing facilities in Shanghai, which you can see on the 3 pictures. And the newest one they opened in 2024, which is the Lingang Research and Development and Production Center. If we take a look at the biggest customers of ACM Research, we can see that 18% of the revenue comes from SMIC, 15% from SIEN, and 13% from CXMT. And all of those companies are based in China, and they are smaller companies. And some of them also have bigger customers such as AMD and NVIDIA. But directly, ACM Research right now is not selling to those bigger and important players, but more to the smaller companies based in China. Now that we have a good overview of the company, I want to take a closer look at the numbers and also give future predictions for the stock price. So in this chart, we can see the price to sales ratio and the price to earnings ratio over the last years, starting from 2018. As we can see, in 2021, the stock was trading at an all-time high at a P/E ratio of around 100, and then the stock fell a lot, and now the P/E ratio is sitting at around 15, which is very cheap considering that even though the stock has gone up and down a lot, every quarter the revenue has basically increased, and also earnings per share are increasing very rapidly. So over here I created a special Excel sheet which can help us calculate the future return. So I'll do my best to try and explain it. In the top we can just see basic information about the company, the market cap of 1.3 billion, 558 million in revenue, and a net margin of 16%. If we take a look at the share price, then the share price is $20 and it's earning $1.30 per share, which is a P/E ratio of 15. Now, what's very important for this calculation is that we subtract the cash and add the debt on top of the market cap, which gives us the enterprise value, which is more important when calculating the actual value of the company and also future price. So right now it's trading at a P/E ratio of 15, but if we adjust that P/E ratio for the enterprise value, because it has more debt than cash, then the company actually is trading at 18.6 P/E ratio if you think about buying the entire company. And over the last 5 years, the company did 592% revenue growth per share, and that's 47.2% every year in revenue growth. So we just take that growth number and we estimate that in the future the growth rate will be the same for the earnings per share as it has been in the past, assuming that the net margin stays at 16%. Now, what's very interesting is that if we calculate a fair P/E ratio where the company should be trading, then the company should be trading at a P/E of around 46 if we include cash and debt and also the growth rate, but it is trading at a P/E ratio of 15, which is why we can see that in 2025 the prediction for the P/E ratio in this chart goes from 15 to 47, which gives us a share price of $92, but this is also the optimistic case. If we take a look at the following years, we can see the earnings per share in each year if we assume that 47% growth rate. And then in the chart down below, we can see the earnings per share and the future price. So these are very optimistic numbers, but they are also very realistic because the company is trading at such a low price and the growth rate is so high. So the prediction is that the company's earnings per share right now are $1.30, and in 5 years from now, if they continue the growth rate, which they've had consistently over the last decade, then earnings per share should be at 9.3. And if we also assume that the P/E ratio increases to a fair valuation, because right now they are very undervalued, then that would actually give us a share price of $451. Now, most of you are probably going to say that 47% is very optimistic for a growth rate, and that's why I also made a pessimistic calculation in which we assume that the future revenue and profit growth rate is going to be half of the one that we have seen over the last years. So in this calculation, we are going to assume a growth rate of 23.6% every year. In the table, we then can calculate the earnings per share in the future, and in 5 years, the earnings per share would increase from $1.30 all the way to $3.90, and in 10 years from now, the earnings per share could be over $11 per share in a pessimistic case for the company. Also, the fair P/E ratio will drop to 27 because the growth rate is lower, and companies with a lower growth rate tend to trade for a lower P/E ratio. So we also have to adjust that. And then in 2029, if we add up the earnings and calculate the P/E ratio, then in 2029 the stock should, in a pessimistic trade, case trade for a P ratio of 30. Right now it's trading at a P ratio of 15, and that gives us around $117 per share. So even if we have a pessimistic case, we can still expect the company to 5 or 6-fold in the next 5 years in the stock price, and in the optimistic case we can expect an even higher return. If we take a look at the next 10 years, then the range gets even bigger because it's very hard to predict the numbers going out more and more into the future. So in the pessimistic case, the share price could be at $350 per share in 10 years from now, and in an optimistic case it could go up all the way to $3,000 per share, which is way, way higher than $20 per share right now. And that's also why I made this video, because I find it very interesting that such a fast-growing company with low debt and good cash position is trading at such a cheap price. So that's my conclusion on the company, and comment below.